Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. I want to wish you all a happy new year and kick off the year with some good news from the Cryptopolitan. XRP triumphs with 5 million holders in a groundbreaking milestone. As the year 2023 concludes, XRP, a leading crypto, is on the brink of an impressive milestone. With its user base nearing 5 million, XRP continues demonstrating its enduring presence in the digital asset space. At the time of this recording, XRP is up over 83% year over year, and I hope we can finally put this bullshit SEC case behind us. That'll be the first catalyst, then a possible XRP ETF, then mass adoption by the major global banks, and then finally the Ripple IPO itself. All of that can happen in the new year, and I'm excited about all of it, not investment advice or advisor. Please hit the like button and share this video on your social media platforms so the news in this episode gets around and gets some traction. I know a lot of you have become jaded and immune to good news on AMC and the movie industry, but I love these headlines from The Hollywood Reporter. 2023 box office, domestic revenue clears $9 billion in post-pandemic first. Thanks, Barbenheimer. From Deadline, 2023 U.S. box office crossing $9 billion, led by Universal. Wonka tops New Year's weekend with 31 million plus. And then finally, led by Wonka, holiday films push 2023's box office past $9 billion. Domestic box office will finish 22% ahead of 2022, but around 20% below pre-pandemic levels. What you may not understand is hundreds of hit piece writers on AMC had a tidal wave of articles ready to beat the stock over the head with that read, "Industry misses $9 billion goal for 2023. Now they'll just have to stick with estimates that show the 2024 box office will be less by $1 billion for the year, another empty prediction we will probably destroy. I hope you will agree that this milestone flies in the face of everyone that declared the movie theaters are dead, like Gasparino, Greenfield, Chanos, and many more. When we achieved this goal in spite of the writers and actors strike. Imagine what we could have done without that, or if we would have dropped Dune this year. This event will be mentioned again and again in every meeting, in every studio, with every streamer, and with every company considering the viability of the theater business. It was important. Okay, now before we look ahead to 2024, populate that events calendar and discuss AMC's path to a possible short covering event, let's take a brief look back for the setups for what's coming next. This is the tone we need to be aware of before the bell on Tuesday morning from Zero Hedge. Fiat alternatives fly in 2023 as Powell pivot sparks $20 trillion surge in global stocks and bonds. Global stock and bond markets added almost $20 trillion in capitalization during 2023, but here's the important part, and all of that gain came in the last 2 months of the year after it had tested unchanged on October 28th. The gains were dominated by global stocks, which added $13.3 trillion, while global bonds rose by $6.1 trillion. Okay, that's 2 to 1 on stocks to bonds. Don't forget that. Now let's add this chart into the equation. Cash is king. Money market funds saw their largest annual inflows ever. That means there's lots of money left on the sidelines, so that leaves a couple questions. Where's it all going to go once it's deployed? Will any of this money find its way into the new crypto ETFs? Will it flow into the AI darlings of Wall Street like the Magnificent Seven? Will this spark another rally that can blow out even more hedge funds in 2024? Well, for the first time since the first quarter of 2022, new hedge fund launches outpaced liquidations. In the run-up to mid-2023, around 109 hedge funds reportedly closed, a slight rise from the preceding quarter's 102. But, the past year, ending in 2Q 2023, saw only 393 new funds, whilst 500 were liquidated. Stay tuned. This chart depicts the power of the Powell pivots and its impact on the NASDAQ, which soared to its best year since the peak of the dot-com bubble in 1999, and the rest of the U.S. major equity market indices all rallied. Having said that about the NASDAQ, here's a quick hat tip to my gold bugs out there and an interesting point on perspective. Pay attention. Before we dig into the details, here's an odd one. Since the close of 2021, the S&P 500 is almost perfectly unchanged. Oil and bonds down 10%. Gold and CPI up 10%. Who says gold's not an inflation hedge? In my opinion, if it wasn't for the advent of the crypto space, gold would be at $30.20 per ounce and may still get there, because if the dollar goes the way of the dodo and loses its world reserve currency status, I ain't buying BRICS currencies, Shiba Inu or Taco Cat. Gold will be the last chair you want to sit on when the music finally stops. Maybe a little silver, platinum, and palladium too if you have the extra scratch. And a final 2023 hat tip to Black Arrow, Dom, the Magic Donkey of Canada, an optimal projection from the zombie Wolverine state, gold, a weaker dollar, signals of loosening from the Fed, and a world on fire means no one should be surprised by gold's great year, up almost 14%, its best year since 2020, to a new all-time record high. Congratulations, gentlemen. And what about gold's immediate future? Well, according to Zero Hedge, China and Russia are dumping bonds and buying bullion, and the market is starting to sniff it out. 2023 saw the biggest rise in the market's perception of U.S. sovereign credit risk since the Lehman Brothers crisis back in 2008. Uncle Frank believes money managers around the world will rush to buy those bonds back, but we shall see. Speaking of bonds, they ended higher in price and lower in yield on the year. Gold up, dollar down, oil down, natural gas collapsed as the Fed shocked the world, suddenly flipping from uber hawk to full dovetard. On December 1st, U.S. Fed chair says premature to speculate on rate cuts. But by December 13th, Fed policymakers discuss timeline to start rate cuts. But the Fed is supposed to be apolitical, right? Inflation was transitory, then it wasn't. You know what, guys? At this time, I'm long AMC, which does great during tough economic times and downturns, and XRP, which is the best mousetrap on the planet for cross-border payments and is excellent at one thing in particular the entire financial world needs right now, and that's unlocking captured liquidity. So I don't care what happens, except I pray this bull rally keeps running and burns the trapped shorts straight into bankruptcy court and or prison. Now, this slide may seem like I'm talking about 2023, but it's all about 2024. This is really about acknowledging a trend and guessing if it will continue. The Magnificent Seven stocks dominated the price action and outsized index gains in 2023. Investors preferred the safe haven of the mega cap tech names over longer duration profitless tech until the Fed unleashed hell at the start of November and everything exploded higher. Now, guys, look at that bottom chart. That's a record. 72% of the S&P 500 stocks have underperformed the index this year. You can't face the new year without keeping this in mind. And what caused the Mag 7 to rally like that? Guys, don't kid yourself. It was AI. From Goldman, the apparent benefits of AI know no bounds when it comes to investment, as Goldman's basket of AI stocks soared over 90% this year, while businesses at risk of AI's impact rose 17%, helped by the everything rally in the last 2 months. This was and is a black swan for the predatory short hedge funds and is exactly why Ortex reported U.S. stock short sellers down $145 billion in 2023. A late surge in stocks is exacerbating the pain of short sellers who are on track for their worst collective annual loss since 2020, according to data and analytics company Ortex. And here's the interesting part. This shit ain't over. The impact of new tech like AI will come in waves and stages, in my opinion. Now, this is one prediction I have no doubt will materialize in 2024. AI will dominate customer experience in 2024. Artificial intelligence expert John Heaps tells us how and why AI will dominate the CX space in 2024. He further cited a survey that polled business owners to find out how they currently use or plan to deploy AI. Quote, its number one focus was customer service at an overwhelming 56%. He told us as he contemplated customer experience in 2024. But guys, that's just the tip of the iceberg, because I think the shorts are going to have their hands full with other potential problems. I'm so convinced new applications for AI are going to drop at this year's Consumer and Electronics Show, January 9th through 12th, that I put it on my events calendar. AI will go way past customer service at this show, and I'm actually anticipating breaking news items to come out of this event. Now, why do I say that? Well, this is on the homepage for the event. Taking problem solving to epic new levels. AI is revolutionizing the user experience. Whether increasing accessibility or boosting efficiency, AI's state-of-the-art hardware and software solutions play an active role in industry development worldwide. Still not convinced? I'll give you one more headline from Wired. Get ready for a tsunami of AI at CES, which kicks off January 9th in Las Vegas and will feature the usual assortment of new consumer tech products. But this year, even more of that stuff will be empowered by machine intelligence. Guys, do you understand this represents another black swan for the predatory short hedge funds that are trapped in their short positions? This is important. On topic, the Motley Fool picked 4 artificial intelligence stocks to buy before 2024. Number 1, Alphabet Google. Number 2, CrowdStrike. Number 3, Airbnb. And number 4, Adobe. But what does AI itself think? The 500 top stocks to buy for 2024 ranked by artificial intelligence. AI picked MasterCard, symbol MA, Verisk Analytics, symbol VRSK, and TJX Companies, TJ Maxx, symbol TJX, not investment advice or advisor. My last slide on 2023 is dedicated to crypto, and it was a huge comeback year after 2022's existential threat moments from FTX to Terra USD, and so on. Of the larger coins, Solana massively outperformed, up around 1,000% on the year. But Bitcoin up 160% and Ethereum up 100%, also had big years. What do you think about XRP going forward? For the year, it was up over 80%, and this piece from November 30th gives you some context. XRP's current price is 0.6116, up 79.9% from the start of 2023. The XRP all-time high was $3.84 on January 4th of 2018. Currently, XRP is down 84% from there, and it broke a long-term bearish trend line in August of 2022 and has been trading sideways ever since. So what's my call? Well, I believe once we are officially out of court with the SEC, there are a number of catalysts that can drive XRP to a new all-time high. I still believe we will take out the most recent highs before we break 4 and settle somewhere between 4 and 5. For now, that's my initial price target. Now, I will never tell you to buy, sell, or hold any stocks or cryptos. This is not financial advice, and I am not a financial advisor. It's merely my own opinion. And how did meme stocks do? Retail favorites had a wild year, but ended up 25% in 2023. The best year since 2020's chaos, thanks again to the last 2 months of panic buying, and they call it dash for trash trading. But Uncle Frank, I've got AMC down 82% over the past year. You know, make sure you keep believing the imbeciles on Twitter like Really Bad Person, Boss Schmuck, and Little Bigums. Keep believing their narrative that this is all Kenny Griffin and Gary Gensler's doing. This has nothing to do with ridiculous private placements of our stock at 10 cents on the dollar, placing it with known former short sellers of our stock, no less. This is all while we had about $750 million in liquidity. Yes, this is the only way. We have to sell down here in the basement, just like we did with the ape. You remember the pounce, today we pounce? I haven't heard Adam mention our preferred share in many months, or even the apes themselves for that matter. I'm sure this stock drop has nothing to do with a reverse split we never needed, or strategically timed rally-killing tweets about bankruptcy risks or dilution. These guys on Twitter have zero knowledge of investment banking, and everything they learned about capital markets they learned over the past 3 years. They are completely brain dead, or they're being paid to advance a narrative. You decide for yourself. Now, on topic, I'm really excited about this quantitative analyst, Rocky White's research on potential short covering rallies early in the new year. Why 2023 underperformers could pop in early 2024. Short covering rallies could be coming in January. According to Rocky's analysis, out of the stocks that had at least 5% of their float sold short, and according to MarketBeat, AMC is at 9.25% as of December 15th. I think it's 10 times higher. The stock's down at least 10% on the year, and we certainly qualify for that. Those perform best in the first 5 trading days of 2023. Those stocks gained over 4% for the week, and 75% of them positive, and an impressive 70% beating the SPX, which was up 1.4% in that first week. So guys, I like these odds, especially on the heels of hitting $9 billion as an industry for the year. So expect another Adam Aaron dilution announcement with one of our former short sellers on Tara if we get a rally. But if enough of the heavily shorted stocks under Rocky's criteria suddenly all rally, that's beyond the control of Adam Aaron and the predatory short hedge funds. Then it's on like Donkey Kong. So Uncle Frank, under what conditions can AMC experience a short covering event or a MOAS in 2024? That's simple. A collapse of the leverage chain within one or more of the predatory short hedge funds, just like what happened with Archegos, Credit Suisse, and might even be threatening to take down UBS in the near future. In my opinion, this can only happen as a result of a black or white swan event. Period. There is no amount of good news out of AMC, any rules or laws from the regulators, a new special dividend that the shorts will be forced to pay. AMC could sell off all its stock and pay off all its debt. None of that will force the hedge funds to cover and destroy themselves. It's suicide. Not with Wall Street, market makers, regulators, hedge funds all working together in concert. Any other way at this point is impossible, in my opinion, especially with elements within AMC working with Wall Street through Citi, our chief investment banker, and Morgan Stanley running our board of directors. We would need a sudden event that turns the primes against their best customers, the hedge funds. And I will take you through that process step by step. The collapse of Archegos Capital Management in March. A drop in the share price of U.S. media group Viacom CBS following a stock sale sparked chaos on Wall Street. That's a swan, and one of the most dramatic collapses in the finance world. It's an intense tale of winners and losers featuring several of the largest investment banks, including Credit Suisse, a shorter of AMC, Deutsche Bank, Goldman Sachs, a shorter of AMC, a spoofer of AMC, Morgan Stanley, who runs AMC's board of directors, MUFG, Nomura, a shorter of AMC, UBS, now owner of a short position against AMC, and Wells Fargo that acted as prime brokers for an ill-fated client. Now, stick with me. The client in question was Archegos Capital Management, a $10 billion family office founded by renowned New York investor Bill Wang, which was ultimately the biggest loser. The investment firm faced off with its prime brokers in late March as they demanded collateral to cover the fund's exposure on swaps it had purchased on Viacom CBS and other technology stocks. Archegos failed to meet the margin calls, prompting a massive $20 billion fire stock sale as the banks, or at least some of them, rushed to sell off the fund's positions to make cash so that Archegos could pay what was owed. The alarm bells began ringing publicly on March 29th when investment banks Credit Suisse and Nomura, both short sellers of AMC, both declared that the event had significantly impacted their prime brokerage businesses. By the time the dust settled, Nomura tallied up a weighty $2.87 billion loss from the event related to winding down of positions and changes in market prices. Speaking to investors on Nomura's first earnings call in 2021 shortly after, Chief Financial Officer Takumi Kitamura said the Japanese bank had taken a disciplined approach to exit our positions, taking into account both market impact and minimizing losses. Guys, when these hedge funds short AMC, they take in cash. Okay, they never have any intention of paying it back. There's a difference between a normal short seller and a predatory short hedge fund. A normal short seller shorts the stock at 15, wants to buy it back at $5 and keep the difference. A predatory short hedge fund is in it for the long run. They are going to short it, they're going to take in the money, they are going to invest it in other things, they are going to leverage it up 60 to 1, even higher. Okay? They never want to sell it. Why, Uncle Frank? Because that would create a taxable event. Okay, they have no intention of ever doing that. There are still hedge funds out there that are short Toys R Us and Blockbuster. Okay, in Switzerland, Credit Suisse counted an eye-watering $5.5 billion total loss following the Archegos default, the largest loss suffered within the prime brokers by far. The fallout forced Credit Suisse to raise $1.9 billion in capital from investors to counter its balance sheet after the Swiss bank was also left reeling from insolvency of its supply chain funds partner Greensill Capital in November. Credit Suisse and Nomura were not the only banks to have prime brokerage relationships with Archegos. Wall Street heavyweights Goldman Sachs, short seller of AMC, spoofer of AMC, and Morgan Stanley, who runs AMC's board of directors, alongside Europe's UBS and Deutsche Bank, also had close ties with the family office, but all four were reportedly much quicker out of the gate in exiting the fund's positions that fateful week. And there's a picture of little Bill Wang in custody. Guys, that's the only way it's going to go down. That is the only path to a MOAS or a short covering event. That's it, in my opinion. Not financial advice. This is not a financial advisor. This, to me, is the only way, the only path. And guess what? These companies, these people, these predatory short hedge funds, they have a tendency of destroying themselves. Okay? So, you know what? Don't tell me it never happens, because it just happened. Credit Suisse was a 167-year-old bank. It is gone now. Okay? It had a 90-cent price target on AMC. It was short AMC. Guess what? It's gone now. It can happen. It does happen. This is not financial advice. I'm not telling you to buy, sell, or hold the stock. This is the only way there's going to be a short covering event, and it's just one man's opinion. You know, I think I have something that might better explain this to AMC shareholders. A lot of you are under the impression that AMC is run by a bunch of movie guys, like entertainment guys, people from Hollywood, the movie business. No. AMC is run by Wall Street, top to bottom, left to right. Let's start with our board of directors. That's Philip Lader, the leader of our board. He is still a senior advisor to Morgan Stanley Institutional Trading. We got our CFO also from Morgan Stanley, all right, mergers and acquisitions. Adam Aron himself was senior operating partner of Apollo Management, a giant private equity firm. They paid him for 2 years after he began running AMC. And then there's Derek Van Zandt. That's our lead investment banker from Citigroup. These people came up with the APE, its conversion, the reverse split, all of it. That's Citi, a short seller of AMC. Another known short seller of AMC, Himanshu Gulati of Antara Capital. Okay, this is the guy we sold APE to at 60 cents. This is the guy we are swapping equity for debt with, like at 10 cents on the dollar. Antara Capital would not exist if it wasn't for Blackstone, okay? A huge hedge fund. They backed Antara 100%. Guys, do you want to know why Adam Aron, his entire senior management team, and the entire board of directors haven't bought a single share of AMC in 6 years? It's because they knew it was going down. Okay, these people actually sit in the boardroom. They actually know what's going to happen. Okay, get it through your head. None of the people on your screen are going to do anything deliberate to hurt the interests of Wall Street. The sooner you accept that, the easier this is going to be to understand. Okay, let's start filling up the calendar with events that hedge funds and prime banks need to concern themselves with. Now remember, Uncle Frank doesn't think any of these events on their own will cause a short covering event for AMC or a MOAS. In my opinion, it will be a convergence of events coupled with a black or white swan that will cause a breakdown in the leverage chains of the predatory short hedge funds, creating a rift between them and the prime brokers that enable their activities, setting the stage for a liquidity crisis and possibly margin calls. Now, 128 days from now, from the DTCC, shortening the settlement cycle. On February 15, 2023, the SEC adopted final requirements for a May 28, 2024 implementation date for the move to T+1 settlement for transactions in U.S. cash equities, corporate debt, and unit investment trusts. the Securities Industry and Financial Markets Association, SIFMA, the Investment Company Institute, ICI, and the Depository Trust and Clearing Corporation, DTCC, are collaborating on efforts to accelerate the U.S. securities settlement cycle from T+2 to T+1. Now here's another regulatory challenge for our hedgy friends. On October 13, 2023, the SEC adopted Rule 13F-2 under the Securities and Exchange Act of 1934 and Form SHO. The new rule and form will require institutional investment managers that meet certain thresholds to report short position data and short activity data for equity securities. In addition, the SEC amended the National Market System, or NMS, plan governing the Consolidated Audit Trail, or CAT, to require the reporting of the CAT of reliance on the bona fide market-making exception in Reg SHO, also known as CAT amendments. All right, the effective date of Rule 13F-2 Form SHO is January 2nd, 2024. Put that on the calendar. And the compliance date is 12 months later, on or around January 1st, 2025. The SEC will begin to publish aggregate data about 3 months later, approximately in April of 2025. The effective date for the CAT amendments is also January 2nd, but the compliance date is July 1st of 2025. So what are the key takeaways on Rule 13F-2? Don't worry, I'm not going to read the whole thing to you. You could go to Morgan Lewis and read up on who has to report, what securities transactions are reportable, what are the reporting thresholds, what is the reporting requirement, when are the reports due, and when is aggregate data published. That one I will read. Form SHO is required to be reported within 14 days after the end of the month, and then the SEC will publish aggregate data about a month after that. So key takeaways, they should change that title to how we're going to get around this and keep our unfair advantage over the retail investor. So you guys know where I stand on all this kind of stuff. Rules and laws mean nothing without enforcement. Big hedge funds and market makers don't follow rules, and regulators don't enforce them. Is this going to stop everyone from marking sell orders as longs, misreporting, self-reporting? These big hedge funds have rat hole accounts all over the world. If you're found breaking securities rules and laws and all that happens is a small fine, then the wealthy are above the law. It's just that simple. But I root for all these kinds of developments, and that's mainly because since the regulators won't do their job, investors will take the bad actors to civil court to get justice. Now, don't get it twisted. Before you call me a shill, I want to say for the record, I like anything that makes the battlefield more dangerous for our enemies. I just refuse to pin my hopes on the same people that orchestrated taking away the buy button at Robinhood. Guys, you know I can't promise anything, but I think this January is going to be lit, and the hedgies are going to have to tiptoe through this minefield, and I predict some may not survive. Beginning January 2nd, Tuesday, first day of trading, we're going to see final box office numbers and other related data for the industry and for AMC. Same day, that's the effective date for Rule 13F-2. Form SHO and amendments to the CAT NMS plan. Early January, Epstein's alleged victims and associate list is to be made public. You think that has nothing to do with us? Think again. This time, Wall Street and Washington are going to be on the hot seat, not just celebrities. January 3rd, Wednesday, U.S. job openings. The 4th, Thursday, ADP employment, initial jobless claims. The 5th, Friday, U.S. employment report and unemployment rate. January 5th to the 10th, that's the Bitcoin ETF approval window. Monday, January 8th, consumer credit. Will January be the month that Credit Suisse UBS trillion plus swap finally expires? January 9th, Tuesday, trade deficit. Also, That's when the Consumer Electronics Show begins. We're going to be getting a lot of artificial intelligence information from that convention. The 11th, Thursday, initial jobless claims, CPI, core CPI year over year. Friday, PPI, core PPI. Also Friday, AMC has 3 high potential movies dropping for that weekend: Mean Girls, The Beekeeper, and The Book of Clarence. Friday, January 19th, that's the first government shutdown deadline. Will January be the month the national debt exceeds $34 trillion? Monday, January 29th, Evergrande liquidation hearing. And how about this one? Final XRP settlement with the SEC, that could drop at any time. Announcement of an XRP ETF. XRP adoption announcement by major global banks, or the Ripple IPO announcement. 5 countries are expected to join BRICS in January. How's that for a hot month? Now, just so you guys know, Wall Street is coming over to crypto. And while they're at it, they're going to fix all these pesky settlement issues too, right? This is like letting the fox babysit your pet hamster. Now, I want you to know all the key players. Frank LaSala, that's the president, CEO, and director of the DTCC. Where'd we get him from? Bank of New York Mellon. Then there's Nadine Shakar. Where's she from? Bank of New York Mellon and State Street. And then Gloria Leo. Where's she from? Bank of New York Mellon. But prior to that, a managing director for Goldman Sachs for 20 years. What could possibly go wrong, right? Okay, now from December 11th, the DTCC closed its deal on Monday to acquire Securrency as traditional finance crypto integrations continue to emerge. The purchase was first announced in October, and it was part of a bid to help accelerate the expected greater institutional use of on-chain assets amid an industry-wide tokenization push. The financial market infrastructure giant offers clearing and settlement services, processing trillions of dollars in securities transactions daily, as stated on its website. Securrency is a blockchain-based financial and regulatory technology developer. The acquisition, made for $50 million, formalizes DTCC's current blockchain pilot efforts and is expected to deliver an institutional post-trade platform that supports most digital asset products, according to Elliot Chun, a partner at advisory firm Architect Partners. This includes existing securities wrapped in on-chain assets, he added. Quote, "The DTCC has been forward-thinking in its use of blockchain, and the cost and operational efficiencies are well suited for DTCC to impact the entire securities industry," Chun noted in an October research note. The acquiring firm, renamed as DTCC Digital Assets, is set to be led by Nadine Shakar. The executive joined the firm from State Street in January. A DTCC spokesperson did not immediately comment on the combined firm's next steps. Securrency has been in the thick of tokenized efforts seen in recent years as traditional finance giants have looked for ways to get more involved in the blockchain and crypto segments. Oh yeah, buckle up for that one, guys. Now, if the DTCC and the SEC are so concerned and forward-thinking about its use of blockchain, why are they opting for a cash creation and redemption mechanism instead of settling in crypto, which you can't F around with? The US SEC has opted for a cash creation and redemption mechanism to address its concerns over market manipulation. Yeah, that's what they're concerned about. In the event it approves the launch of a spot Bitcoin exchange traded fund, or ETF. The use of cash creations means new shares of a spot Bitcoin ETF will only be created or redeemed through cash transactions. Okay, like the current system. Unlike traditional ETF based on stocks and commodities, which typically use an in-kind model where market participants handle the underlying assets directly. Okay, well, you know what, guys? Add derivatives to that list and you could see what we've got going here. Here's the list. right from the Bloomberg terminal of all the companies trying to bring Bitcoin ETFs. So I see Grayscale, 21 shares in ARK, BlackRock, Bitwise, Van Eck, Wisdom Tree, Invesco and Galaxy, Fidelity, Global X, Franklin, etc. Here it's coming, guys, and you know what? I think it's going to be more of the same. This is new manipulation opportunities for the bad actors on Wall Street. Okay, guys, let's put some more swans on that calendar, shall we? Look at this one. Wall Street wants us to think the commercial real estate crisis is over. It's a thing of the past. From Fortune. What's next for commercial real estate? After the $500 billion wipeout of 2023, it's a lot more complex than mass obsolescence. Industry watchers stay. Well, let me tell you what's next. JER Investors Trust, a mortgage real estate investment trust or REIT, filed for bankruptcy in the latest sign of distress in the commercial real estate area. And then from last month, China Evergrande Group on Monday said it has been granted an adjournment of a court hearing into a liquidation petition for January 29th, giving the embattled property developer time to finalize its revamped offshore debt restructuring plan. The decision came as the world's most indebted developer, with more than $300 billion in liabilities, sought adjournment unexpectedly unopposed by the petitioner's lawyer. You know what, guys? I'm starting to think we're not going to get a straight answer from the financial media or the prime banks on the commercial real estate crisis, so let's check in with the academics. Commercial Real Estate Outlook for 2024. A National Bureau of Economic Research paper warned commercial real estate loan defaults could reach Great Depression-era levels if interest rates stay high. USC finance professor Erica Zhang discusses the risks on Yahoo Finance Live. Zhang noted falling property cash flows, declining values, and refinancing challenges raises distress, especially for offices, multifamily households, and hotel operators. With 15% of commercial loans already underwater presently, Zhang notes default outlooks now don't look very good. She highlighted commercial real estate offices as particularly exposed, with 45% of office loans underwater, meaning the property value is below the loan amount. This makes refinancing unlikely as it has high default risks. Okay, let me translate. Half of the whole thing, the office building loans, are underwater already, guys. So I guess we should conclude there's nothing to fear from the commercial real estate crisis anymore, right? Then explain this headline. Financial contagion warning as HSBC is told to brace for catastrophic £6.3 billion hit. Bob Liddon fears losses in Hong Kong and China could blow a hole in the bank's equity. And why did one of our short sellers lay off nearly 1,000 people before Christmas, Barclays? And the Financial Times. Banks shed 60,000 jobs in one of the worst years for cuts since financial crisis. Trend set to continue over coming year amid subdued deal-making and listing activity. Is that why? Okay. Guys, it's officially an election year now, and I want you to be ready for a shit show of enormous proportions on the calendar beginning this very month. An article from Forbes. Here are the likely government shutdown deadlines for 2024. From the article, Congress has passed a continuing resolution, H.R. 6363, to avert a government shutdown before the November 17th deadline. The continuing resolution avoids any government shutdown risk for 2023. However, the markets now have two potential shutdown deadlines for the markets to pay attention to in January the 19th and February of 2024. This approach is unusual because previous continuing resolutions would fund the government in its entirety until the resolution expires. Okay, so guys, they doubled the opportunity for this to blow up the financial markets. Instead of one deadline to worry about, now we have two. I kid you not. You see, guys, they have literally doubled the opportunity for a crisis, and it starts mid-January in an election year. They're calling it a two-tiered approach. The continuing resolution gives separate extension deadlines for different areas of government. 4 appropriation committees have a deadline extension until midnight, January 19, 2024, and then the remaining 8 areas of government would have their funding expire 2 weeks later on February 2nd. It's like they turned one swan into 2. Now, guys, there are some developing stories for January or the first quarter that are difficult to pin to a date on the calendar, but are still very real for American businesses and consumers. According to S&P Global Intelligence, there were 591 corporate bankruptcies in 2023, one of the highest bankruptcy totals since 2011. Only 2020, with 639 bankruptcies, witnessed more. So American businesses are struggling. Now add this to the equation from the Boston Globe. In reversal, U.S. to heighten efforts to collect billions in unpaid COVID loans. The Biden administration plans to more aggressively pursue thousands of small businesses with past due pandemic loans, reversing an earlier policy that saw the U.S. government stop short of trying to collect an estimated $30 billion in delinquent debt. You know, he needs more money to send to Ukraine. Now add this to the equation for a small business. Almost 10 million workers in 22 states will get raises on January 1st because the minimum wage is going up. And now for the consumer on student loans. For most borrowers, the first payment after the payment pause ended was due in October 2023. U.S. credit card debt surpasses $1 trillion. Can consumer spending withstand the pressure? Car payment defaults hit 29-year high as borrowing costs surge. And then in China, Xi Jinping rings in 2024 with a rare admission that China's economy is in real trouble. China's businesses are struggling and job seekers have trouble finding work, President Xi Jinping acknowledged during his Sunday New Year's Eve speech. All of this seems to be coming together like a flock of swans. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.